We are going to talk about SIPs today. What happened was a few days. Sorry, I'll just mute everyone. Okay, so what happened a few days back was there was this debate that started on Twitter about SIPs in India and how people don't make money if they go through the SIP route. The data that was used to do this analysis by the person who posted it, they said that JP Morgan has done this analysis and they have come up with the conclusion that the return net that a individual investor would have gotten is around 6-7% over a long period of time if they had done a nifty SIP. So this got me and Manish thinking that this cannot be true because 6-7% is way too low according to us. And we wanted to do the numbers ourselves and figure out why JP Morgan concluded what they concluded. So then we started this journey, and given the fact that we live in the AI era, we got to use Claude and do a lot of number crunching, and I wrote some code. And then the truth revealed itself that the number that they are quoting is actually the CAGR. So
a small caveat here. मैं यही सोच रहा था इतना डम तो नहीं हो सकते यार these people के SIP में CAGR number use करेंगे because I think that is class 10th maths. So apparently I was told again through artificial intelligence, ये Claude ने और Grok ने बताया that what they were using is called as adapted CAGR. Problem is even adapted CAGR is not a right metric to judge that, as Varanya did the reverse invert mathematics to come home to that point, and he'll explain that.
Yeah, I don't even know what is adapted CAGR, and I don't like the word adapted when it comes to finance and accounting. Warren Buffett and Charlie Munger taught us when you see such terms, just run away. There is nothing adapted in finance or earnings. When you have earnings or you don't have earnings, there is no adapted earnings or classified earnings or a classified EBITDA or slightly changed EBITDA. I don't believe in that. You have to follow what the generic norm is. So for SIP or financial returns for any asset class, when you want to understand what the return has been for your investment, there are only two great measurements. Actually, there are three, but two are the ones that concocted. Yes, Kiran, you're bang on. So for us, at least, returns, when you are measuring returns, there are two ways to do it. One is you put in money lump sum and then you wait and then you get a return over a period of time. That is called CAGR, compounded annual growth rate. That if you had invested this money at that number and you were linearly getting that number every year, you will make that much money. Second is when your money is coming over time, like in an SIP. In that case, we cannot use CAGR because the money has come on different time periods. Now, when the money has come on different time periods, basically what we need to use is present value calculation, which we all learned in high school or college or whatever. So present valuation is you discount the cash flows either into the future or into the past and then see what is happening. And one more craziness that happens with especially a SIP return calculation is that you don't know what that discounted rate of return number is that you need to use to calculate the present value. So you need to use a computer where hit and trial method is used to calculate that rate of return. That is what we call the internal rate of return, XIRR, a lot of people call it. So that is one difference that people need to understand. When you are comparing nifty returns from one time period to present, you cannot say that the CAGR is this much, but the SIP return is not up to the mark. Because SIP return is completely different. What about the SIP that happened 5 years ago or 2 years ago or 1 year ago? You cannot have the same CAGR that Nifty has had for 15 years or 20 years or 30 years on the investments that you have just made. So this is a difference that we wanted to highlight this time. We put it in our newsletter also. But then that got us thinking that what is the actual data? I mean, if if somebody had done SIPs in the broad indices that are there in India, how much money would they have made? Okay, so that is the analysis we wanted to talk to you about today. So let's start. Now, first, we wanted to answer the question, do SIPs actually work? Is it worthwhile to do this whole exercise for 20, 30 odd years where you are saving money every month, putting it in any kind of investment funds out there, and then waiting for the money to grow? Do the SIPs actually work? So it turns out they do. This is the returns that we calculated just for the broad indices that are there in India. So as you can see, the data for some of them is not available since the beginning, but whatever we had available, we use that. So Nifty, we had data starting from 1990. So the odd 35, 36 years that Nifty has been there, a 10,000 rupee SIP every month, which meant that there were 432 months that we invested for, today would be worth around 5.3, 5.4 crores, giving us a XIRR of 11.4%. Now, there's a difference here. The CAGR might be higher, okay? But for very long periods of time, I realized that the CAGR and XIRR tend to become the same. But XIRR will slightly be lower because you have investments on different time periods, so they average out.
So slight nuance, sorry to interrupt, this slight nuance here. This is something that my backtest suggests as well. It's pretty fascinating, guys. The difference between CAGR and XIRR depends on the path that particular index has taken. अगर वो index बहुत ज़्यादा volatile होगा, ups and down, crazy momentum में होगा, चाहे upside चाहे downside, उसका हमेशा XIRR ज़्यादा होगा compared to the CAGR. Case in point is Nifty value Nifty 500 value 50 का जो index है. That is a crazy gyration index, and its XIRR is almost 2 percentage points higher than the CAGR because you're getting the chance to buy it cheaper.
Yes.
Yeah, so please continue.
So the more volatile it is, the higher the chance that your difference between the CAGR actual of the index and your return on the SIP is different, because then you get to buy at different points of time. So anyway, that is Nifty. Then we come to Nifty 500, which is the broader market, top 500 stocks. So we had data for around 27 years. 32.5 lakhs invested has turned into 2.7 crores at a return of 13.2%. Mid cap has always been a winner, but again, the data that we had was starting from 2005. So since 2005, the return is around 15.7%. Your money invested, 25 lakhs, has grown to around 1.76 crores. Again, with Nifty small cap, same time period, around 13.5% return, and the money invested, 25 lakhs, has grown to 1.3 crores. Now, 2-3 things to notice here is broad indices. These are all broad indices of India. Okay, anything that we do have most decent stocks will fall under all of these indices. The average return is around 11 to 15%. Okay, which is what has been taught to us in the past few years. Mutual funds सही हैं, आपको 11-12% बन जाएगा, 13% बन जाएगा, over time सब ठीक हो जाता है. All this data includes all the crazy time periods. This one also includes the 94 crash. This includes the 2000 crash. This includes the 2008 crash. This includes the COVID crash, everything. In spite of that, 11.5%. This one also includes most of the crashes. This one includes the two big ones that we have seen in our times, 2008 and 2020. Still, the return is 15.75 and 13%. So broadly speaking, broad indices in India tend to give you around 11, 12, 13, 14, 15% returns over time. Okay. Now, this is not a God given. Okay. Why is this happening? We should question this also. It's not like there is this physics rule that if you invest in something which is equities, you'll always get 11, 12% return. India is a growing economy. if we are growing at 6, 7%, 5%, my personal take is our general equity markets should grow twice of that, because the returns that we see in GDP are inflation adjusted and stock returns are not inflation adjusted. So generally twice of that. Thumb rule economics says whatever the country is growing by plus the inflation rate, you see somewhere around that number of growth. So say a baseline case, India grows at 4% bare minimum, okay, and inflation is also at 4-5%. So 8-9% return we can expect from the broader markets. If India is continuing to grow at 6-7% that it has for some time, and the inflation is around 5-6%, then straight away we get to the territory of 12%, 13%, which we can see here. So this is not a physics number. This is actually how we are growing. If we continue to grow as a country, as an economy, this number will remain intact. Okay, the day we stop growing, this number will come down. It's very simple, directly correlated numbers. Okay. Next. These are the broad indices that we talked about. What about real schemes? The real mutual fund schemes that we can invest in. What about them? What kind of returns have they generated? So let's look at those also. These are the top 6 highest AUM mutual fund schemes in India. I just took out the data. Most of them have been around for a very long time. But the data that we have available in terms of their NAV and to do the calculations around what the SIP returns would have been is available from 2010, 11, 13, something like that. Now, I don't know why is that the case. My gut feel tells me that mutual fund industry tends to not reveal data of big drawdowns. But it might just be the case that that is how the data is available today. And maybe before that, they were not tracking the data. But
no, also a fact that the data from mutual fund industry has survivorship bias, in the sense that a lot of schemes get amalgamated, merged together. Like the bad ones are merged with the good ones for the overall picture to look good. So you have to take everything with a pinch of salt. Yeah.
Yeah. But so if you see that the data here that is available does not include the 2008 crash where market went down 50-60%. Okay. So if that data was there, maybe these XIRR numbers would be lower, but we can work with what we have. So I just picked that up only. Now, even here, if you see the returns average somewhere around 13, 14, 15, 17, 19. One of them, Nippon small cap has returned 22%. But if you really think about it, these dates, this 2010 period till today, we have had a very, very, very big bull run. There has not been a very big crash till date. COVID crash was very fast. Markets didn't fall way too much. But 2008 was crazier. Okay, so that the time period is not included here. So this bull run has actually rewarded a lot of people. 22% is very high for 15 years. But again, as we see here, the average is not 22, average is somewhere around 16, 17, something like that. And these are the biggest mutual funds which have performed the best in India, because because of their performance, they are the biggest today. If we go further down and look at other funds, you will not find them performing as well. Okay, so we can safely assume these are the best of the best in India. What I want you to understand here is look at these numbers and just keep them in your mind for the time being, that average is around 15, 16, 17%. Now let's go further.
बंधन का डेटा नहीं है क्या? Because बंधन small cap
बंधन का बहुत कम टाइम का है और बंधन small cap would be much higher than all of them.
हाँ, लेकिन डेटा नहीं है.
But that's an outperformer. So yeah. Bandhan small cap is very different. Anyway. Yeah. Okay. Plus, it's not as large. These are very big schemes, all of them, and they have been around for a while. Now, the story doesn't end here. Okay. We are just getting started. As we saw in the previous slides, the index return itself for this time period has been very high. Okay. If I look at the mid cap return, Just see this part. 17.85% is the mid-cap return for the same time period, 2013 till today. So anybody who has gotten 16, 17, 18, they didn't have to do much hard work. The market itself was rewarding you. Okay. Look at the small cap returns, 15%. This is for the time period of 2013 till now. We saw earlier from 2005. Now we are seeing the same time periods that we saw with the schemes. I'll show it to you again. These are the scheme returns. Most of them start from 2011, 13, something like that. And when I look at the index itself has rewarded us a lot. So the simplest conclusion that we can draw here is it's very difficult to beat the index. Okay, this is one core belief that we have, that unless the index itself is performing very well, it is very difficult to beat it. For a longer time period, starting from 2005 till today, mid cap has already returned us 15, 16% in an SIP. So what kind of difference are we expecting from the schemes when they are performing very similarly? These schemes are not.
And remember, this is plain vanilla index, guys. ये तो अभी factor index भी नहीं है. We're not talking about the momentum indices. Just the normal index, mid cap index has generated around 16% CAGR.
Yeah, for this time period. Not the 16, it is actually close to 18, which is crazy. As I said, this has been a huge bull run starting from 2011, 12. Everything has gone up. We have had a very, very good bull run. So whatever the schemes have returned, unless they have done far better than this number, they have all been around the average itself. Now, as I said, 2005 till today, for the 21 odd years, it's already 15.7. Starting from 2013, it's around 18. So very difficult to beat these indices. That's the first point that we wanted to raise. Now, second point. This is the final number, right? But what is the journey like? They don't keep going up in the straight line. All of these schemes fall. Okay, let's look at the data. So this is Nippon small cap, which is the biggest outperformer, as we saw, 22% XIRR return. But look at the type of falls that they get. COVID fall was around 45%. Now, just for a second, stop and think about what this means. We started in 2010. We started putting in 10,000 rupees every month. We are saving. By 2020, we have now around 10 years of savings, which is basically 120 installments that we have paid. Suddenly one day, whatever money we had accumulated has gone down by 50%. This is where the problem starts. This is where people start getting jittery. They will either stop their SIPs, or they will try to sell, or they will try to say that stock markets don't perform, they don't give you money. And right from there, things start moving back up. Okay. It is easy to say that have faith in the market, things will get back, things will get normal. These are just temporary blips. But just think of some person who invested for 10 years or 20 years, and then one day all of their corpus, not just the new investment, everything that they had invested in and saved on and made some returns on, all of that money has gone down by 50%.
So this is pretty fascinating, guys. I'll give you a live example. Last week, we went to Mumbai and had a chance to meet this very famous guy. So pretty fascinating conversation ensued, and he showed us the Excel sheet of his actual SIP returns as they were progressing when the Corona crash was manifesting. You'll be shocked. At the bottom of the Corona crash around March, his 10-year SIP that he was consistently investing in, some lakh rupees or lakhs of rupees every month, 10 साल की SIP went negative.
Yes, the total return was negative.
Minus 10 साल की SIP went minus in a Corona crash. That is the kind of damage you have to go through to earn this 15% return.
Yeah,
please
continue. Now 2 points here. One is, even that will work. Okay, if you have faith and you stay put and you say that यार मुझे फर्क नहीं पड़ रहा, I don't care. I have trust in India. I have trust in the Indian economy. These are just gyrations, which is the story that is sold to every one of us. That, you know, these are just gyrations. Just wait it out and you'll make it. That will work. Even before we get into anything else, I'm going out there and saying this will work. You will get your 14, 15%, whatever the index return will be or the scheme returns will be, you will make it. But according to us, most people don't make it. You can see this data for yourself. Mutual fund investors will not get the returns that the mutual fund has generated just because of this one problem, that when things go bad, people behave differently. So, and nobody's out there trying to solve this problem.
So I
And
think there was someone did publish this report in 2023. I'll get back to you who it was, but the underlying conclusion was that the average retail return is less than half of what the mutual fund NAV says. So net average retail gets FD like returns from equity like risk. Yeah.
yes. Now think about it again. 22% return is what Nippon Small Cap has given. But at what cost? That sometimes you'll see your portfolio go down by 50%. We don't have the 2008 numbers. I'm pretty sure this number was around 60 in 2008 because that's the nature of the market. Second point that I wanted to raise. See, all these mutual funds, right? They don't have 15, 20, 30 stocks. They will have hundreds. Okay. If you open up any mutual fund portfolio scheme and look at the stocks that they own, they'll have 0.5, 0.1, 0.2, 0.1%, a lot of holdings. Crux will be in top maybe 20, 30, but there will be a lot of stuff down the line, which is how an index is made. Okay. They don't have incentives to outperform the index by too much because if they try to do that, they will also outperform the downfall. Okay, they will fall further than the index. Nobody wants that. Nobody in the mutual fund industry wants that. They are all fine getting 1 or 2% more than the average returns because that works. That will enable them to gather more investors, gather more AUM, which is basically what the idea here is. Okay. ICICI large cap. This is the large cap fund, only invests in big companies in India. We saw the returns were somewhere around 13, 15%. Look at the drawdowns. When COVID type situation comes, we can fall as much as 35, 36%. PPFA's flexi cap, everyone knows about this fund. They are I'll again say they are probably one of the best out there. They also fall 30% when the market falls. But then we are expected to stay put. Obviously, it's easier to look at a 30% fall versus a 50% fall. But then the point is PPFAS didn't perform as well as the Nippon small cap. So we will come to that. Multi-asset funds, again, this is touted to us as the lesser risk investment because they invest in different asset classes and because they have gold holdings and some other debt as well. So they should fall lesser. They also fall around 30%. HDFC Flexi Cap, one of the largest funds out there, 40% fall during COVID. HDFC Mid Cap, again 35% fall. Now, this is the point that I was trying to make. In 2008, if we had the data, all of them would have fallen far more. All of them. Okay. They have no incentive to come in cash. PPFAS, when they were very sure that the market is very, very highly valued, they came out in 20% cash because the numbers are so big that much cash will not work for them. So just a fact of life for mutual funds. Okay. Now, here's what our point comes in. We pay around 1.5%, 2% total commission for owning these funds if you are going through a distributor like us. Our simple question is, we are not getting extraordinary returns. We are getting maybe 1%, 2% higher. Then why are we paying more? When the market falls, we'll fall as much as the market. When the market is rising, we get maybe 1 or 2% extra. Then what is it that is working for us and giving us an advantage, a leg up over other people, or just the index? Because I have to see the same kind of falls that the index falls through, and I have to see similar kinds of returns also. But the payment that I'm making to these schemes are higher. Okay. Our simple question at Inflow, both me and Manish, we talk about this. Then why do we pay more? Why can't we just look at the index and invest in that? Because the index will give us whatever return we are looking after, and with a similar kind of fall. Okay. And if we are invested in the index, we can sort of start timing it as well. Timing basically means at extremes, we can take calls. For example, many of you would have been there with us in March this year. We saw that the market had fallen quite a bit. That was the peak of the war. And then at one point we decided that, okay, this is too much. Let's put some cash to work. Okay. We could have been wrong easily. We are not fortune tellers here, or we didn't know what the future was like. It's just probability that at that point of time, we felt that, okay, this is a good time to buy more. So we bought. Thankfully, it worked out. But mutual funds will never do that. They will always try to stay invested. Okay. So if we are at the index level itself and we take these few calls over a long period of time, we feel that we'll do even better than the mutual funds, right? Now, we actually went and back tested this. We've been sharing this data for a very long time with a lot of potential clients. Uh, what we do here is we combine two factors, momentum and value, or momentum and quality. And just by the virtue of combining two different factors along with 30% cash, this backtest, we kept 30% cash all through, starting from the beginning till the end, never making any calls on buying more or selling more. Still, we get around 16%. So you can imagine that, if we just do things a little differently, we can achieve what the index is giving us, and then look at this number. We have fallen lesser compared to most indices. Third point, we pay lesser. We pay less commissions to the funds. See, just in interest of disclosure, these numbers are before the commissions or before the charges. So it will fall a little lower. But even if it is around 14, I'm happy because I'm not falling that much. And the behavior of investors changes when the fall comes. All of us know this. So this is our core thing. If we are looking for returns and we don't want risk, what can we do? See, drawdown is basically risk. Drawdown is what we just saw, how our portfolios fall. If we don't want any drawdowns and we want decent returns, the only thing that is out there is FD. Okay, we get mild returns and we sit somewhere here, and the drawdown will be almost nothing for us, and we make money. If we want a little more risk and we go for a higher drawdown, we can go for debt funds, where you are taking a higher risk. Say a company fails, then their debt will become worthless. Majorly, you will not see big drawdowns, but say something like a 2008 happens, even those debt funds will not perform and they'll fall. So if you are a little more risky guy, you can do this. If we are willing to go through that 60-70% kind of fall, which the mid cap index did fall in 2008, the mid cap index itself returned you 17-18%, right? So if we are willing to do that and just say that I believe in the mid cap story, stay invested, you will get higher drawdowns, but the returns will be higher. This is what we are trying to do. We are trying to combine a few of them, say momentum or value or quality. And then along with cash, we are taking bets. Our backtest says we'll lie somewhere here. Our returns will be slightly lower, but the drawdowns will also be lower. But if we are able to time it as well, which we intend to do, we can actually go from here somewhere around here, where we can say that we actually made more money with a lesser fall, right? So this is what we had for you today. If you have any questions, please, we'll open it up. Manish, if you have any points to raise on the presentation.
Yeah, just one point on this, and this is something I have experienced over the 14 years career that I've had in this industry. Returns 1-2% ऊपर नीचे doesn't really matter as long as you get it. The point is you won't get it. Majority of investors that I have worked with do not get this 14-15% return. And that is a very sad state of affairs. क्योंकि वो पैनिक में बेच देते हैं और वापस ज्वाइन करते हैं यूफोरिया में. See, it's very easy to be an armchair investor sitting and watching on Twitter, looking at screenshots, लोगों ने कितना पैसा कमा लिया. On average, nobody is making money. I was running MWM, so I can tell you there were only 8 people, single digit 8 people who actually had the entire 27% CAGR. Let that sink in. उसमें से 5 फैमिली थे. So पूरी रिटर्न किसी को नहीं मिलती. And as if this is not enough, 2/3 of people left us in 2018-19 का 28% drawdown. 28% drawdown लोगों से नहीं झेला गया था. So just imagine कोरोना का 35% या फिर 2008 का 60-70% drawdown कौन झेलेगा? Now, but my point is, how many people can see a 10-year negative SIP return figure and still continue with SIP? नहीं होंगे वो लोग. 10% भी नहीं होंगे. So sure, if you are in that 10%, go ahead. That is a good journey. But since majority of us are not, this particular plan that we have come up with is best of both worlds, where we have a tap on the drawdown. 30% is always deployed in cash, which gets deployed at opportune moments to take advantage of the drawdown. The overall drawdown should be below the pain threshold. Yeah, with that, we should open with this.
I have one more point to discuss here. So we keep discussing this internally. We are working as distributors. So in our own incentive, the best thing to do is to sell the story that stay invested, stay invested, stay invested. Don't do anything. Keep putting your SIP. Keep having faith in India. Don't do anything. But the data shows that that doesn't work. Why doesn't it work? Because people will leave at the worst time. If people are going to leave at the worst time, we need to come up with something better, which is what our efforts are towards. That, you know, can we avoid even one fall? If we avoid even one fall, or maybe lessen the impact that the market has fallen maybe 50% and we fell 20-30%, that itself we feel might let people stay invested for long. Because see, returns, everyone will get similar. It is very difficult to beat the index. We both work with this assumption that we are going to get 14-15%. Let's get that straight. But 14-15% is a very good return if you are able to actually achieve it on your portfolio. We don't know many people who actually get it unless they are full time and they're doing it day in, day out. Very, very, very difficult to get that return. So that is our core point, that what we are trying to do is somehow, reduce the drawdowns, reduce what happens when the market falls, and then enable people to take the ride. Yeah. Great. So with that, we open up for questions. Any kind of questions we are fine with. Manish, you had one more thing that you wanted to share, right? About the.
Okay, guys, so this is not a related topic, but a topic close to my heart. 5 years ago, I was able to successfully leave this habit of smoking. So I was a smoker for good 11 years and wanted to quit, but just couldn't quit it. And then finally, I was able to kick the butt with the help of this book by Alan Carr, The Easy Way to Stop Smoking. Now, willpower alone cannot help you leave smoking. And this book has been a life changer for me. So, just as a give back to society, and since I've been able to do it, I'm a fucking nobody, not that disciplined or whatever. I was able to pull it off. And so I'm pretty sure if the right exposure is given to people, they'll be able to do that as well. So, what I came up with is the second slide visible, Varanya?
Yes.
So, here's my pitch. If you know someone who wants to quit, please send them our way. What we intend to do is gift them this book, the Alan Carr's book, which has been a game changer for me, and single-handedly I was able to drop this addictive habit. And then we'll probably read it together, create a group of some, let's say 10-15 people, a small group, same pace with the check-ins along the way, urging each other, and probably helping someone kick the butt. We finish the book and drop the habit. So the beauty about this book is that it works in reverse psychology. It will not ask you to leave smoking. It will not even tell you कि कितना नुकसान होता है smoking से. it will keep telling you, smoke another one, read a chapter, smoke another one. And gradually through a reverse psychology brainwashing, by the end of the last chapter, आप अपने आप ही you'll be disgusted and you realize that what a schmuck you've been, and you will drop the habit like cold turkey. I was able to do that, and there have been a lot of people who've been able to pull this off just by reading this book. I think Salman Khan, Hrithik Roshan, that in Hollywood, Kutcher, a couple of other people were able to just, they attribute this book as the reason why they've been able to leave this addiction. So just as a giveaway, since I've been a smoke-free guy for last 5 years, this will be the 5th year anniversary. So I want to help around. If you know someone who wants out, please refer them to us. Send us an email at info@inflowealth.com, and it'll be a good karma from my side as well. Even if I am able to, let's say, convert 3 or 4 people and help them de-addict, it will be pretty awesome. Yeah.
Great. Great. Well, yeah, with that, we'll open up to questions. Anyone who have any questions?
Thanks, Manish, for the book and also for India regarding the overall presentation. Manish, this book also helps for social smoker or occasional smoker as well?
That is correct. The book has chapters for all kind of smokers. It dedicates a chapter to people who call themselves occasional smokers or just social smokers. A whole chapter is dedicated to them and helps them come out of it as well.
Okay. And thanks regarding the presentation. I have a couple of doubts or questions regarding them. One is the overall presentation to me sounded more like, yeah, definitely a little bit of timing is required to make sure that the returns are captured. Or if that is the case, then what is the role of quality mutual fund that we have in our portfolio is playing in the whole scenario? Because momentum actually captures the highest return, and maybe drawdowns are cushioned based on the timing, and we can move to cash or debt fund. Why do we even need a quality?
Yes. So if we go with only one, if we say go with only momentum, then we'll have higher drawdowns because momentum will not work all the time. If we go only with quality, then we'll have higher drawdowns because quality will not work all the time. Our test suggests that they are inversely correlated to some extent. You can see it right now. Momentum has done well and quality is going down. So
see, this question is stemming from the recency bias, my friend, and I completely understand. I've been on the same page. Me and Varanya have had many discussions कि ये quality is such a bad drag, इसको रखना क्यों है? But this is recency bias. Quality has not done well in the last 5-6 years. But if you look at the overall scheme of things, let's say a 30-year back test, you realize that in a lot of cycles, quality is the only solace. It does well. When momentum is not working, quality does well. So when you combine the two, they're very smooth. Having said that, right now, even if you remove quality and put in, let's say, a mid cap or any market-based index, it will do the same job. Yeah.
yes.
No, my question was more on the direction that if quality starts to perform, they will eventually come into momentum, there, maybe with a lag, but they will eventually. Yeah.
Yes.
Interesting. But
See,
sometimes
there's another thing here, Rakesh. Momentum funds, the momentum indices that we track and we own, they have a rebalance of 6 months. So every 6 months, they will take a decision. Okay. Now, say for that 6 months, the market has not done anything or gone down. We'll see a downfall in the momentum fund as well. So the beauty of it is even though the 6 month rebalance is there, it still works. Now, say we get 1 6 month period where at the beginning of the period, everything was hunky dory. And during those 6 months, things went very, very bad. So for entire of those 6 months, things will start looking very bad to us. It can fall quite a bit. because they will not change the stocks as per the rules. With the quality one, say those quality stocks are not falling in those 6 months, then we'll get saved to an extent. Momentum might have quality at that time, might not have quality at that time. Now, say if we get in a double jeopardy where quality had worked a lot and then momentum was also holding the same stocks, and then the market falls, then both of them will start falling together. But again, not all the time that will happen. So what we are working with, the assumption is that hopefully, say 70% of the time, both are uncorrelated, and then we have a smoother run. As Manish said, right now we are tinkering with the idea that what if we move away from the quality product that we have selected and go for, say, some normal index only along with momentum. Maybe that will do the similarish kind of job, but we are still waiting and watching what is happening, because right now the biggest reason quality has not worked is IT. It is heavy on IT, and IT has not worked for anyone. So if IT starts performing, maybe we'll see some kind of returns there. But yeah, the fact of the matter right now is it's not working. I hope that answers your question.
Yeah. Thanks. And follow up on that, like the overall presentation was eye-opening, but at the same time, what was missing out, or when Money says that people chickened out, was that usually everybody invests for a goal. So yes, definitely, if we keep invested for a very, very long time, yes, there would be a return. But what if we have a specific goal in 10 years, 20 years, and then within that
Exactly.
time frame we want to achieve? That's
Exactly.
the part. That's the tough part which everybody goes through, and maybe that's the reason why we chicken out.
Exactly.
Correct.
Now one more point to add to what you said. If you have a goal coming up, okay, and say, I was listening to the presentation of PPFAS just, I think, 2 weeks back. They had a investor call, and Mr. Rajiv, who runs their fund, Rajiv Thakkar, is it, Manish? Yeah. So that guy was saying that if you need money in the next 3 years, don't invest that money in equities. My view is also similar. If you need money in the next 3 years, take that money out. Anything can happen. Your goals should not be impacted. You should say your goal is to buy a house 10 years from now, then plan for the seventh year. Okay. Don't plan for the 10th year. Plan for how you will have that much money ready by the seventh year. Because stocks are nobody's relatives. They can fall without telling you. We live in a world where one news event blows up the market. So if you have saved up for a goal, 3 years, I'll say, is the time frame you should look at to get that money into debt or into FDs, and then don't destroy your goal. Don't wait for the market and don't say, okay, I'll whenever the purchase date comes, only then I will withdraw. I think that's a bad idea.
So I wrote a blog long time ago on this subject, for your daughter's sake, where I alluded to precisely this point, Ashish. See, market doesn't know that your daughter has to get married on X day. And also, there are funds that are getting launched with the name of child fund or whatever. They are doing the same equity investing. Child fund has nothing to do with your child. With your child, it's just that the words are getting used because it loosen your purse and it's easy for you to buy it. Otherwise, it's the same equity that they will invest in, and equity comes with risk. The drawdown doesn't care whether your child needs to go to do his MBA. And so as a customer, we need to figure out that only that money goes in the market, which is cold money, which we will not touch for, let's say, ye to, Varanya is still very generous saying 3 years. I normally suggest put the money in equity, which you're not going to touch for, let's say, 7, 10 years. Yeah.
No, I'm saying not for, don't put it for 3. I'm saying, say your goal is 2025, 26, then your money should be out of equities in 2023, irrespective of what the market is doing.
Correct.
And people call me foolish for this. They say I'm too conservative. I have made a lot of clients do this. Uh, that, somebody told me I want to buy a house next year, what should I do? I tell them just liquidate your portfolio today, because we don't want to be responsible for you not being able to purchase your house. If you have invested for a while, you have made money, and now your purchase is coming up, then it is the best thing is to put it in an FD.
Because
Don't.
point is, if you're not hedging it, I mean, I'm pretty sure 95, 96% of the retail is not really buying those December puts, right? Since you're not doing that, that portfolio doesn't owe you anything. Market can correct 30% any on the brick of the hat or whatever, and then you're 30% short in buying your dream house.
Okay. So, Varenya, what I was saying was our experience 2 years ago when I wanted to buy an apartment.
Yes,
You said liquidate your portfolio, sir. And this
yes.
is what we did. Otherwise, by now, I think still it would have been in red. So that was a very good decision. And
Yes.
so what Varenya is saying is all makes sense.
Yes. Yeah, Ashish is our client from a few years ago. And he told me that, he has finalized the house and he needs money for that. And I told him, Ashish, I don't know what the market will do, but you please take out your money and just keep it in an FD. I think it worked out well for him. He sold, by chance, he sold in 2024 end before the market started falling. So right at the top. But that was just by chance.
So this is a pretty interesting case study, Ashish ji and everybody else. Let's just do a hypothetical experiment and say the market that rallied like crazy in these last 2 years. Would you diss at Varanya now? तेरी वजह से मेरा पैसा डबल नहीं हुआ.
No, that was not the only money I had, right? That was one of my investment that clicked at that point in time, and I wanted to check with Varenya if this is better or should I, sell some of the other investments. So, so I mean, it is actually it is you have to diversify your portfolio in various, like you guys say. So
Yes.
it should not be only your money to buy a house. And again, when you buy a house, again, all those things come in, that what money, which money, metal, or, so that was not the only money. And I never, and actually, Varenya is one of those guys, he never asked for money. I have to push him to say, Varanya, yeah, I mean, invest more. I mean, you can even, invest that liquid bees. He puts some 30%, 20% in liquid bees. And I say, you can invest that money in the stock market because that is not the only money I have. I can give you more once you invest everything 100%. But he has his own, ways of working, which I don't interfere. I respect that. And yeah, I mean, he's doing very well actually. So I mean, there are different ways of working. One guy, like Varenya, he's very methodological. He thinks, he sees, and now he started talking about timing, which he never did before. So we all learn, and there are other guys in the market who always say, no, invest more, invest more. This is the time. This is the time, even if that is not the time. So I'm fully satisfied, even if it had gone 100% up. I had my goals. I'm not greedy. So I would not have said anything. I would have had a cup of coffee with Varanya for the right decision.
Thank you. Thank you, Ashish. Thank you for the kind words.
Good to know, Ashish ji. Thank you.
Thank you. Yeah.
Yeah. Any other questions? Please feel free to ask. See, there's this thing, as I said in the presentation as well. If we just stay invested, we will all make money. There's a high chance that we will. The problem is not that. The problem is that we are all humans, and human beings behave differently given the scenarios that they are exposed to. So I might be a good investor, but in COVID, I had very bad times because I was building a house and I needed money. And I had a reverse experience actually. I couldn't invest at that time. That was a very good time to get in. In fact, Ashish ji, who you just heard hearing. Uh, he also at that time felt that things are very bad and what should we do? So everyone behaves differently. I needed money to invest at that time. I couldn't invest, and things didn't work out for me. Uh, so now I'm a big believer with, especially with Manish, who's a very good timer of the market. I honestly believe there are times when you should put everything into the market, and then there are times when you should take probably everything out as well. So yeah, anyway. What's your take on the new categories of investments emerging for retail like SIFs or IFSC bound investments? Yeah, that's a great question. I think the SIF question we answered last time also. So, Nilam, SIFs first, just to give you a caveat that we are not very big experts on SIFs. We have not done a lot of work. Just my own core take on SIFs is it's sort of, from what I understand, that it is a lot sort of long short fund where they'll also take some derivative based bets on the downside, and they will try to protect the falls in the portfolio. As I said earlier in the last call also, I'm not a big believer of long short because I feel that these funds are always long short. Long short, according to me, will work when you are long at some times and short at the other times. Those are the people who make big returns. I'm not too sure if I'm always long short, how well will I do? So I'm not a big believer in that. IFSC bound outbound investments, I have a big take on. Most of these products are launched when the bull run has already been there for a while. US has outperformed a lot of markets for a few years now. This is the time when all these products are being launched and everybody is being asked to put money into the US stocks. And everybody is excited that they will buy the next Micron, they will buy the next Nvidia. My experience says bad time to invest. These things happen right at the top. Everyone will put in their money and then they will realize maybe India was a better destination to put the money in. Okay. Look for places where things are looking bad. That is what has worked in the past. I think that will continue to work in the future. Very extreme valuations in the US right now. I did this small calculation recently. 45% of the total S&P 500 is just 10 stocks today. 45%. Anything goes wrong with those 10 stocks, the market will crash there. And most of the other stocks are not working. Now, say somebody starts using these outbound investments, where do you think that money will go? Nobody's sitting and finding what's the cheapest stock available in the US right now. What is a small, maybe say a pharma company or a biotech company doing? Everyone is interested in these Nvidias of the world and the Microns of the world and the big names of the world. So most people will invest in that only, and I think the result will be bad. So I am not
That
a
is,
big.
yes, I agree with you, Varanya. But the only thing is, his point is valid that we should have a IFSC associations because there can be international opportunities that can show up, which we do anyways through the mutual fund route. Like mutual funds within AMFI allows us Taiwan, Brazil, China, US exposure. But yes, it's always good to have more options.
Yeah, we have ETFs or mutual funds now which are exposure to Brazil, US, Taiwan, Korea, China. We'll use them. We till date we have not been able to because all of them had been in a bull run, which has
कोरि-
not given us an opportunity. But we will
कोरिया नहीं है,
support.
कोरिया नहीं है.
Korea, अच्छा, maybe Korea नहीं है. But yeah, so we will at some point of time get exposure to them in within what we are doing. But I'm not too keen right now on US especially.
Question from
Exiting,
Rakesh.
yeah, exiting is an easy decision, but getting back in is a tricky thing, and most uptrend is not captured. Yeah, completely agree.
So this
But
is okay, this is something I totally agree with. ये बात 90% of the time सही रहती है कि you have to get two decisions right. एक तो exit decision and एक तो getting back decision. What gives us confidence, Rakesh, that we will be able to pull it off and we've been pulling it off is our precedent. which is something running Mystic Wealth momentum from 2017 till 25, gives us the confidence that if you have an algorithm that tells you when to get in, you will be able to get in.
Index fund use SLBM strategy to compensate tracking error or kind of expense ratio. Is it possible?
What is SLBM? I'm not sure.
Security lending and borrowing.
Some kind of lending mechanism that they get paid to lend the shares that they hold. I have no idea if index funds are doing that.
Yeah, even I don't know.
Okay.
Sorry. You're talking to the wrong people. We have no idea what SLBM is.
So
By
I
the
know
way,
what SLBM is. I don't know whether index funds are allowed to do it or not.
By the way, I spoke with someone. This is very interesting. You know what they do? They don't buy stocks. He told me I only do futures. And I asked her, sir, why do you do that? He's saying, I am getting money at 9%. And if I beat the market, so my funding cost is almost nothing. I have a core belief that I'll make around 15% return. So for free, I am making money. I am not the kind of person who agrees with this. Okay. I have very big problems with things like this.
I think this is a bull run problem.
Yes.
In a bull run, you think कि market सिर्फ ऊपर ही जाएगा.
Yes.
वो futures नीचे भी जाते हैं, वो भी leverage पे.
And look at the MTF book in India. I mean, futures is one thing, but MTF book today stands at, you know how much? 1.34 lakh crores. I hope everyone knows what MTF is. Your broker, when you put a buy order today, gives you an option to buy it on margin, where you only put up some money, the remaining the broker will finance, and the broker will charge you 9-10% interest on that money for the whole year.
Also, there is a user interface is so friendly.
Manish, you got muted.
Yeah. No, I intentionally muted it. My kid had entered the room. What was I saying?
The user interface.
The user interface is so friendly and so nice, and they do it in such a subtle way that I was checking my Angel account and I realized that there's this 12 lakh rupee interest thing happening. I was like, what is this? So even I ended up taking the MTF facility even when I didn't want to.
Yes, it's pretty
smooth
crazy.
बनाया हुआ है.
Yeah, it's pretty crazy. Okay, so think about this from a psychological perspective. When you open a window, we have all this muscle memory. Cancel is on the left button, OK is on the right button. Now, these brokers have exploited it. Okay, continue with MTF is on the right button, and continue as it is on the left. So you have to train your muscle memory to think for a second before pressing the button. I will not name the broker. I work with the broker. They do that. If I mistakenly press the right button, it will go through MTF. Just imagine the kind of craziness. And the book stands at 1.34 lakh crores in India. So that means people have not paid that much money. It is all broker money, and which they are earning interest on. Say a 9% interest, that's a 9,000 crore business right there in front of you. So yeah, I don't know how it works.
Can I ask a question?
Yes,
Hello?
Please.
I just joined in. I just saw that core and satellite. You must be taking the decision before buying that this will go to core and this will go to satellite. In any case, you move that, you've taken a core position and then you decide to move it to satellite or something reverse. I mean, how do you go about it? Okay, this is before buying, you decide if this is core, this will remain core and this is going to be there for a long time, or probably you might change your view on that.
It's a good question, Rahul.
Just wanted your thought.
Yeah, so ideally, when we designed this whole thing, the underlying idea that we had in our mind was that the segregation is based on the money that you have and how it's coming. So let's just say we have clients who are working and they are earning a per month salary. So they want to invest that money on per month basis, not lump sum. Since there's a per month credit that's happening, the SIP candidate for that is the core portfolio. When it comes to lump sum, this is my opinion, and Varanya agrees as well. You need to be very nimble and quick on exits when it comes to your lump sum amount, and therefore that money should go in satellite. So once we get into a happy situation where the SIP goes into core and that core itself becomes quite big, that now it is acting like a lump sum, then ideally you should be putting that lump sum amount also and move it into satellite. So the idea is pretty simple. These are not competing products, they are complementary. Your per month saving goes into core as a SIP product. When that product itself becomes so huge as part of your corpus, let's just say I don't know what your net worth is, but let's just say 30 lakh rupees is a pretty substantial amount for you, and that 30 lakh rupees ही बन गया core में, then those drawdowns would be too big for you. Then you start moving them to the satellite. That's the plan.
Rahul, if I got your question correctly, the core is always fixed. We are not going to make any changes to what products go into the core. One is momentum and one is quality. Right now, for quality, we have this fund called Nifty 500 Quality 30 Index. We are, as we have been mentioning in the past two calls, we are looking at it again. Maybe it's at some point of time we'll decide to move that to some other product. So the core product will always remain same. We will never make any changes to that. We'll always have to index over there. In the satellite, we always are open to anything. We'll buy anything. So there will never be something like, okay, we are making a decision of taking something from core to satellite or from satellite to core. The core will always be the same. That is why it's called core. The belief there is we are doing index investing and we are investing for the long haul. We play around with cash over there. We don't play around with the product. We use the same product, let it stay invested for long periods of time and only take cash calls over there. In the satellite one, we can come 100% in cash. We can get 100% deployed. We can buy any sector. We can buy any country. We can buy any index, whatever we feel like.
Like, for example,
Okay,
as
got
we
it.
speak, like, for example, as we speak right now in our satellite portfolio, we are long defense, we are long pharma, and we have exposure to as a single entry into gold and silver. Yeah.
So basically, you will not have anything. I mean, this percentage of so it is individualized. Basically, you will have this. This is the percent which a particular client has in core, and this much he has in satellite.
Yes. Yes.
So for your entire thing, you will never keep it. This is the fixed. This much is the core is the fixed, and this much will go in satellite. That you cannot
Yeah,
have it.
no.
We cannot. Yeah. This is an individual choice. Broadly speaking, because we are not advisors, we are mutual fund distributors. We don't advise on the allocation percentages. But broadly speaking,
correct.
my advice is always that the SIP should go into core and the lump sum amount you should have more control and should go into satellite. Yeah.
Got it. Thanks.
Yeah. Any other questions, please? You can ask any question in the market or whatever. It's open. I mean,
also, for the second presentation, send in the request, guys, if you know anyone who is interested in kicking the addiction of smoking. I'll be happy to probably convert one and get some good karma. Remember to refer someone who is interested in quitting. Like there has to be cognitive dissonance. That person should be under the impression that he wants to quit and he's not able to quit. Somebody who doesn't want to quit, that is probably not the right candidate. Maybe they enjoy. Yeah.
yeah. I think question from Rakesh.
What is it? It's a presentation as such. You've made anti-smoking.
Not necessarily a presentation. So what I intend to do is gift this book to that person. Maybe let's say if we have a group of 10, 12 people, we'll read that book together, check in with each other, do the follow-ups. And once the book gets finished by the group, the book will do most of the talking actually. I don't think I'm a psychologist who's going to change anyone, but just the see, nobody helped me. I just read the damn book, and the book's a psychological tool itself that if even if you're half intelligent, that book will start talking to you, and you will finally throw the throw the bad habit. Yeah.
See, I have a friend who lost weight and became a regular gym goer, and then he thought that maybe I should become a trainer. So the same is happening with Manish, but it's a noble cause. I have been friends with Manish for many years now. I remember him being a smoker, and now I have seen him not having any smokes for the last few years, and it's a very interesting change. In fact, you should also, if anyone is interested, Manish has also reversed his diabetes by just using dietary methods and not on medicines or not on exercise. So if any one of you is interested or have a family member who might want to talk to him, please go ahead. Because according to me, that was a bigger challenge, even more than smoking. So yeah.
The same principles, by the way. Alan Carr has written a book on this subject as well. Again, the same principle. The idea is to the way you drop smoking, you just drop carbohydrates and sugar.
Yeah, which is
Yeah, I've
far.
seen Manish has reduced a lot of weight in the latest pictures of yours, Manish. So
Yeah. So Rakesh is asking, what about IT stocks? Rakesh, not looking good, yeah, still. I was talking to someone who works at TCS in Canada yesterday. So I asked them what's the ground reality, and they said anyone who's pitching any projects that doesn't involve IT in it, AI in it, is just being rejected. And the scenario is not that great. A lot of things are changing on the ground, so it still remains to be seen. My core belief is the business is not going anywhere. It will have a revival, but in what sense and when, I don't know. But right now, not looking good. I will not invest right now. Manish, please share Koalamagi stuff with us also. Prashant is asking. Yeah,
Yeah,
that's a paid session, Prashant.
oh, really? Okay, okay. I didn't know about that.
No, no,
Okay,
no, no,
okay.
I'm just
no,
kidding.
he's just kidding. So we gave a pretty interesting presentation at Finacle in Mumbai last week, and we'll be happy to share the slides with you guys. Also, the Kolamagi book that Varanya has written, we'll share with the audience here. Yeah.
Sure. Thank you.
Does active fund beat index funds in the long term? Vivek, great question. Some of them do for sure, but how will we know which one will do? Again, how do they beat index funds? Because they have a great fund manager. Now, what happens if that great fund manager leaves that fund and goes and starts his own PMS, which in the past a lot of people have done? Prashant Jain was the HDFC guy for a long time, and they did pretty well under him. Now he has moved on. He started his own fund. So you have to choose the fund manager more than the fund itself. That is my belief. Now we are not good at choosing fund managers. How will we know that this guy is great and this guy is not? Only the past performance can tell you. We feel even if they are beating the index in the long term, they don't outperform it by say 5 percentage points. They outperform 2%, 3%, because it's very, very hard to do that. Very hard to beat index by 5%, especially when you are managing large sums of money. So that is why we have taken this idea forward that, we don't want to go into the game of figuring out which fund will do better than the index. Let's do it with the index only. What is the problem? There's no fund manager risk. There's no issues by going for the index fund. We just saw in the presentation, the returns are more or less similar and the drawdowns are similar. So what is the point in figuring out which fund will do well? In fact, the exercise of figuring out which fund will do well leads people to have 7, 8, 10 different funds in their portfolio, which is basically owning the index, which was what our core point was when we started this journey of mutual funds, that if you have more than 2 funds, you're anyway owning the entire market. So there is no point. Your returns will be same to as what the market will give you.
So Vivek, my answer is India will replicate what's happened in US. You look at the SPIVA reports, you come to know no large cap fund in India beats the index. So active is dead in large cap. Same fate awaits the mid cap and the small cap as well as we move along. In US, no active fund manager beats the index. Same will be happening here as well. And even let's just say 1 or 2 active funds end up beating it. The point is, this is hindsight bias. How would you pick those 2 out of 500 or 1,000 funds?
And see, there are some funds which have done it. Okay. Like we showed, Nippon Small Cap has done it. Bandhan Small Cap is right now doing very well. But they are doing well because they have a great fund manager. Now, it might make sense to put in money with them. But as I said, what if they leave tomorrow? Well, then I will have to figure out what next to get. The idea is not beating the market here. The idea is to get those returns first. As we said in the presentation, according to us, most people are not even able to get those 12, 13, 14% returns in their portfolio. You tell me how many people, one 10,000 SIP for last 20 years is today worth around, say, 1 crore. How many people do you know personally who have achieved that? Who started 20 years back putting small money every month, and now they have the success story to tell that, see, this is what I have achieved. Very few I know. I don't know anyone. My dad is also not one. Forget everyone else. He's been doing SIPs for so many years now, because you know what he did? He bought Franklin Templeton, okay, which at that point was the best performing fund, and for many years now has not done anything. So I don't know. I have no solution to this. What I'm saying is I'm not going to solve that problem. If somebody has the ability to find the best fund and stay with it, very good. What we are trying to do is solving that problem using index funds, and with the core belief that most of the active funds will also not beat it by too much over time. I think, Manish, nobody is asking anymore. So should we?
Yes, make the most of your Sunday. Go out. By the way, it's raining like crazy here.
Yeah, and I heard Mumbai is even crazier right now. I don't know how
Yeah.
many people are from Mumbai over here, but yeah, I hope everyone is fine and safe. I read too much rain happening in Mumbai continuously.
Yeah, my friend just messaged me this photo. A whole tree got uprooted or something.
Wow.
And something towards Bangalore also.
Oh, really?
Yeah, no rains last since the monsoon started. Hardly one time only it rained.
Oh, that's
Your
crazy.
your quote has been taken by Mumbai.
Vivek
Correct.
is doing something. Vivek, do you have a question? I saw you were typing something. Oh, okay. No. Great. So if there are no other questions, guys, thank you for joining. Uh, one point from my side, every month we do this, we see around 12, 13 people coming in. We hope we are adding some value to your journey, or the way you invest, and we are able to do it in a better way. You are our Most of the people who have joined today are our clients already. So if you have people who are interested in investing in mutual funds, please ask them to reach out to us. We are still trying to grow very small. I keep mentioning this every month, that you are our best salespeople. If you like what we are doing, if you see some value being added to you, please refer your friends, family, and we hope that we can do a good job for them as well. Great. Thank you for joining. Manish, do you have anything to say?
No, nothing. This was fun. Let's keep doing that. I was also thinking that we should have some kind of an engagement, maybe once a week, because once a month becomes too long. But we'll take your feedback if that becomes too heavy or whatever. But we'll figure it out.
Yeah, it will be too heavy for me. Okay.
Yeah, okay.
Great. Thank you. Thank you everyone for joining. Thank you.
Right, guys. Good day. Bye bye.
Thank you. Bye.